Hi, and welcome to the Stockscores Market Minutes for March 21st, 2014. Before we get into this week's discussion, reminder that we will be doing some presentations in Calgary and Vancouver early in April, April 3rd and 5th, Vancouver, April 12th and 15th. If you would like to register for one of these events, go to stockscores.com/learn-the-rules. You'll receive a free Mindless Investor book if you are one of the first 500 people registered, courtesy of DISNAT. Now, if you're unable to make it to one of the live events, we will be doing a webinar as well. If you go to that same address, you can register for the webinar, and we will email you in April when we have the details of when that webinar is going to run. Now, I'm going to be showing you how I find stocks like this. This is a swing trade that I did this week. You can see here a break from an ascending triangle on the 13-minute chart. Really good run for this stock, moving from $4.20 to $7 in just over one night. So that's the kind of swing trade that I'm going to show you how to do. And I'll also show you how I find some of the longer term trades that I like to do. This is a weekly chart of a stock that I featured back in, I believe, October at the blue arrow there. And although that doesn't look like much, that's a 50% gain in the course of that period. In this particular strategy, you only have to work on the weekends. So for a trader who doesn't have a lot of time or the desire to watch the market too closely, this is the kind of thing that I'll show you as well. So once again, Calgary, April 3rd and 5th, Vancouver, April 12th and 15th. Go to stockscores.com/learn-the-rules, or you can also, of course, register for one of the webinars that we'll do coming up. All right, trading economics. No matter what style of trading you do, it is important to understand the economics of your trading strategy. Now, you can only do this by testing your strategy over a large number of trades. So if you can test it over, let's say, 100 stocks that meet the criteria of your strategy rules, you have done a test where you can calculate the success rate, the average profit on your winners, and the average loss on your losers. And it's also important to consider how much capital is required for a level of risk tolerance to activate your strategy. You know, we don't only hold one stock at a time. Typically, I might hold 5, 6, even up to 10 stocks at a time. Well, how many trade ideas does your strategy produce, and how many stocks do you tend to hold at any one time? From that, you can sort of make a guess at how much capital is required for a set level of risk. Now, to calculate the expected value of your strategy, you need to understand the success rate and multiply that by the average profit per trade. You then subtract from that the failure rate times the size of the average loss. Now, if you're going to trade a strategy, you must have a positive expected value. Something like buying a lottery ticket has a negative expected value. Playing blackjack in a casino has a negative expected value. We don't want to be gamblers. We want to be stock traders that are trading a strategy that has a positive expected value. And the only way that you can figure out whether you have a positive expected value is to do that testing. Now, it's also important, as I said earlier, to consider the average position size for a level of risk and how many positions you tend to have at any one time to calculate the capital required. So here's an example of what I tend to find with my strategies. It's a success rate of somewhere around 70%, which means 30% of the time I suffer a loss. Average profit tends to be around double the size of the average loss. So if we go with a 2.2 reward for risk average profit and a minus 1.2 reward for risk average loss, we calculate the expected value as 1.18. You can see the formula there on screen. Maybe pause the video if you want to see the details of that. I also find that typically I require about 100 times my risk tolerance in terms of capital. So if I am risking $250, I need about $25,000 to activate that strategy. If I was trading with a $100 risk tolerance, well, it's around $10,000. Now that assumes that I'm using margin for some of my shorter term trades. The average gain with this strategy, this sample strategy that we're talking about here, is $295. That means that some of the trades are going to make a profit of 2.2, which is $550, but of course you're going to have the occasional loss as well, and that's where we get that average profit of $295 and a capital requirement of about $25,000. Now, in my typical, let's say, swing trading strategy, I can probably find 20 trades a week. So if you figure you can find 20 trades a week and the average profit is around $300, that's $6,000 a week using capital of $25,000. Now again, this is just a sample idea to take you through the economics, but that's the sort of thing that I'll be talking about at the meetings in April. All right, let's do our market analysis. Here's a chart of the S&P 500, which has really been stalling for most of March, and it makes some sense that the market would be doing that because it was at the top of its upward sloping channel. And what the market's really doing now is working its way down toward or back toward the lower boundary of that upward sloping channel. Now we can go sideways for 2 months, or we could go down really quickly like we saw at the end of January and hit that boundary. I actually prefer that the market sells off quickly. It makes it a little bit nerve-wracking, but at the end of the day, you get the pain over with and you can go back to the bullish trend. Now, right now, there is really no sign that we're going to make that sharp move back to the upward trend line, but certainly we are moving away from the top of that upward sloping channel. That's a good thing. It recharges buyer interest and really allows the bull market to continue. A similar situation on the Canadian market, again, at the top of the upward sloping channel and likely to work its way back towards the bottom of that channel. Now that does not mean that the bull trend is broken. Until that green line is broken, we have to remain optimistic, but the fact that we are grinding our way sideways and sort of moving away from the top of that channel recharges buyer interest. The TSX Venture, similar situation at the top of its channel for the last couple of weeks, been going sideways. Doesn't have as far to go to get to the bottom envelope of that channel, so I expect that the bull trend will resume a little sooner here. And again, if we had 2 sharp down days, we get there very quickly. I don't think that that's going to happen. Now this week I'm also including a chart of the Biotech index. It's been one of the top performing sectors for some time. This sector really went parabolic January, February. You can see how it's run away from its trend line, and it is now working its way back. It's had a pretty sharp pullback over the last week. This is a week, or actually this is a daily chart. So on Friday it had a pretty sharp pullback, but for the week it was down. And it looks to me like it's going to make its way back to the trend line. So there's still some fairly considerable downside. What's important to know, though, is that when trends go parabolic and they pull back to their trend line, that's not a break of the trend, but it does set up for a period of sideways trading. So my expectation is that the NASDAQ Biotech Index is probably going to cool off for a little while. We could see a bounce. Well, we likely will see a bounce. It'll pull back to the trend line, bounce back, and then it may not make a new high. It probably makes a falling top. And so if you've been long this sector or playing this sector, something you want to keep an eye on here because there is a little bit of a break of that long-term momentum. Now, Treasuries are an interesting chart because if you listen to commentators, everyone says interest rates are going up. And yet, when you look at the chart, you see rising bottoms forming toward resistance at the red line. Now, keep in mind that if this breaks out, if the index here, the TLT, goes up, it actually means that interest rates are going down. So while everyone has this expectation that interest rates are going up, the chart is actually telling us that there's a good chance we're going to see interest rates go lower with a breakout through resistance. Now, it hasn't happened yet, but I do think it's interesting how the optimism is building in the bond market, which would imply lower interest rates. US dollar, a little bit of a hard chart to read. I mean, the long-term picture is bearish. We broke the short-term steep downward trend line. I don't think we're going to break the long-term more shallow downward trend line, but again, it's a bit of a mishmash of a chart. There's a lot of different messages here. I think generally you still have to be pessimistic about the US dollar. Gold has been a strong performer over the last few months, probably one of the leading sectors of the last few months. It too ran away from its upward trend line and is now pulling its way back to that. So I think we could see another couple of down days on gold, but it should find some support soon and really resume that optimism that had been building since the start of 2014. Oil continues to be kind of a neutral chart stuck in this long-term sideways trading range with diminishing volatility. Until we get a breakout from this long-term pennant pattern, you really shouldn't expect too much from the global economy. If oil strengthens, it's either because the global economy is getting better or because there's some political tension in some part of the world that supplies oil. Right now, we're really not seeing either of those things. It's just a sideways trading market. Now, I talked earlier about the S&P 500 and really the market in general and how it doesn't look like we're going to see a break of the trend. And we get a confirmation of that outlook when we look at the chart of the VXX, because even though there's been some weakness in the overall market lately, we haven't really seen a big spike up in the fear index, in the VIX. And that tells me that it's simply a matter of buyers losing their motivation, taking some profits. There's not a widespread fear that the world is coming to an end and that you need to be getting out of stocks. So my long-term outlook remains bullish. I do think that in the short term, we're likely to move sideways, perhaps even lower toward that long-term upward trend line. Gold, I remain bullish long-term, neutral short-term. It needs to bounce off of its upward trend line, and neutral on oil. Stocks are stalling in their long-term upward trend. Expect sideways trading action in the markets as they work back toward their long-term upward trend lines. Buyers are losing their enthusiasm in the short term, but there are no signs that the long-term trend is reversing. Gold is nearly back to its upward trend line where it should bounce and resume that trend. Well, that has been the Stockscores Market Minutes for March 21st. Have a great week in the market and trade well.